Hello and welcome. You're watching ET Markets. I'm Tanya Aneja, and today I'm going to be joined by a very special guest, Mr. Ashutosh Tikekar, Head of Global Markets India at BNP Paribas, is joining us to share his thoughts on the markets, sectors looking attractive after the recent correction, and much more. Thank you so much, Mr. Tikekar, for joining us on ET Markets.
Thank you, Tanya. Thanks for having me.
So, what is your take on the US Fed decision to hike interest rates by 75 basis points? I mean, what is the kind of impact you foresee in India as well as across the globe?
So I think, post the US CPI last time, I think lots of things have changed very, very quickly, literally within one evening on Friday, where the inflation print was 8.6. More importantly, also, I think the long-term inflation expectations is close to 3.5, which is probably a high from 2008. So essentially, markets started pricing in very quickly from a 50 basis points hike to a 75, and Fed delivered that expectations. What changes now, and from our perspective, we have also kind of changed the expectations going forward on the Fed hikes, where instead of a 50 BP hike in the next Fed cycle, we're expecting a 75 BP, a 50 followed by that in August, and then 25 each in November and December. So we are kind of expecting about 3.5 terminal rate on the Fed funds, which is slightly below the dot plot of 3.8%, from the Fed. So what impact does it have? It essentially kind of slows down things a little bit. It's more like a softer landing. I don't think our base case is really a recession. So, recession is not something which we are saying is inevitable, and which is not the base case from our point of view. We think it kind of slows down the demand a little bit. All these hikes are kind of front loaded in a sense. So which means, post we will see all the hikes culminating by December or Q1 of next year, and they would have a plateaued impact for 2023 and 24, and growth can come back a little bit. So, purely from a growth standpoint, we are not in the camp of a recession perspective, both from a US as well as a global point of view.
Absolutely.
I think one point to add there is really from a China perspective, where we obviously China is in a different policy mix compared to the rest of the world. Rest of the world is looking at inflation and hence lower growth. China is still in a bit of a zero COVID policy, and hence the growth is kind of taken a beating. So once that that kind of corrects itself, and once the zero COVID policy or COVID in fact it doesn't has a similar impact, we would see things improving, which are also very critical from a supply side inflation perspective. So once we see a little bit of easing coming from China, we would see these inflation impacts globally as well reduced to a certain extent.
Absolutely. And also FIIs remain net sellers across the globe. So what is exactly pushing them away from the markets? And given that the valuations are now reasonable, do you think that the pace of FII selling could ease going forward?
So from a India perspective, I mean, obviously there have been huge sellers, right? We've seen almost 25 billion plus selling from the FPI or FI community. Thankfully, the domestic investors have more or less compensated the entire outflow, and that's why our markets have been reasonably resilient. So we have seen about, say, 15% down move so far from the top. We probably still have another 10% really to go if things are the way they are, and unless they don't deteriorate further. So I think we are reasonably cautious. I don't think this is time to jump in and say that valuations are great, so we kind of jump in blindly. It's still a market where you probably need to pick names, pick sectors, and play from a little bit more defensively than really going all out.
Absolutely. And also, Indian rupee fell to a fresh record low against the US dollar, actually breached the 78 level mark also. So where do you see the currency heading going forward, maybe in the near term?
So couple of, just a little bit of a precursor. Yes, we have fallen to 78. Essentially, we have gone about, we have depreciated about 5% YTD, which is more or less in line with, most other currencies. What's probably more interesting is, last month or two, where all the other EM markets or EM currencies have taken a substantial beating. And rupee has been reasonably resilient. I mean, we have traded in the 77, 78 kind of a range. Yes, we have reached the 78 mark, last 2 days, but it's still, there is no real panic. So unlike, let's say, 2013, where we saw rupee depreciating 25% real quick, I don't think that worry continues to be there. Obviously, RBI has enough and more FX reserves this time around, closer to 600 billion, to kind of stem any massive volatility if it comes to that. So I think it's still a very stable currency compared to the rest of the region. We can potentially have an impact through, say, let's say a dollar yen. I mean, if dollar yen moves to 140 and the yield curve control, Japan is probably the only country which is still in the QE phase instead of a QT phase. Quantitative tightening is not really happening in Japan. It's still QE. But if that kind of goes away and dollar yen moves to 140 or 140, north of 140, I think it can have some impact on rupee as well. So broadly, for us, I think we think rupee still continues to be in a fairly range trade kind of a zone. We expect rupee to be 79 by end of this year and maybe 82 by end of 2023. So no real fireworks in rupee, as from our perspective. I think it's still a very range bound market.
Absolutely. And also, where do you see value in this market? I mean, which sectors are you betting on after the recent correction? That could relatively be safe bets in a rising interest rate scenario.
So I think few sectors. One, banks obviously are pretty good bet given a rising interest rate scenario. Every time rates are higher, margins are better. So banking stocks are good. Financials have taken a beating. I mean, all financial stocks in general have taken a massive beating from a valuation perspective. So, say insurance actually is kind of a good bet purely from a penetration story perspective. All the companies, who can actually pass on this entire cost push inflation into their pricing model, I think those are names which are still okay. So dividend paying stocks are still a good bet to kind of get into. And lastly, some of the select auto names, and I know auto is probably more discretionary spend, so as a sector it's not that great, but select auto names are still there. I think we have seen demand curtailing, but nowhere close to what the expectations were. So as a sector, it might not look very great, but some of the select names are still okay. And maybe lastly, some of the metal stocks, which again have seen massive downmove in valuations. But with the assumption that China COVID story kind of turns around and the market opens up and all these supply bottlenecks kind of go away slowly, I think there is a story on that as well. So few sectors still. I mean, it doesn't look as gloomy as what we are made out to be so far.
Absolutely. And lastly, are there any near-term global triggers that investors should watch out for?
I mean, the same ones which I think the whole market or world has been in trouble with. I mean, inflation story is the biggest story so far. Continues to play a big role, purely because we kind of started off the year with a transitory inflation kind of environment, and that changed very quickly for most markets. And both DM and EM. So inflation still plays a big role. Geopolitical situation, both from DM, US or EU, as well as EM stocks, they play a big role. From an India perspective, I think we need to watch out how monsoons pan out, and given our inflation basket, the food inflation is about 45% of the headline CPI basket. So a good monsoon is very critical to contain inflation from India perspective. So good monsoons, I think that's something which we should watch out for, and investors are still kind of looking at that. So we probably have another 3 months to go, and that's when we kind of see some pickup coming in.
Absolutely. And on that note, Mr. Tikekar, thank you so much for taking the time out and joining us here on ET Markets today.
Thank you very much.
Thank you so much.